What if the next major economic crisis isn't caused by banks collapsing, but by homes sitting empty, prices staying impossibly high, and millions of people being locked out of ownership forever? For years, we were told that real estate was the safest investment on earth. Buy property, hold it, and wealth would follow. But beneath the surface, warning signs have been building, quietly, steadily, and dangerously. Now experts are beginning to ask a troubling question. Is the housing market heading toward a crisis unlike anything we expected? This isn't 2008 all over again. It may be something even bigger. At first glance, the housing market appears resilient. Home prices in many regions remain historically high. Rent continues climbing. Developers are still building. Investors are still buying. So what's the problem? The issue is that this stability may be artificial. Low housing inventory, institutional investors purchasing single-family homes, short-term rental conversions, and restrictive zoning laws have created an environment where prices remain elevated, not because markets are healthy, but because supply is constrained. In other words, prices are high not because people can comfortably afford homes, but because there aren't enough accessible homes available. This creates a dangerous imbalance. When affordability collapses, demand weakens. And when enough buyers are pushed out, markets can suddenly freeze. Mortgage rates have surged compared to the ultra-low rates many buyers enjoyed just a few years ago. For the average household, this means monthly payments have skyrocketed, even if home prices stay the same. A house that seemed affordable in 2021 may now cost hundreds or even thousands more per month. Meanwhile, wages have not kept pace. Inflation has eroded savings. Debt levels remain high. Younger generations are delaying ownership. This has created an affordability crisis that may be more severe than a pricing bubble. People aren't just unwilling to buy, many simply can't. And when first-time buyers disappear, the entire housing ladder begins to destabilize. One major shift many underestimated is the role of corporate and institutional investors. Private equity firms, hedge funds, and large-scale landlords have purchased massive amounts of residential property, transforming homes into income-generating assets. This has several consequences: reduced supply for regular buyers, increased competition, rising rents, neighborhood consolidation, greater market vulnerability if investors pull back. If large investors begin selling due to economic downturns, rising rates, or declining returns, housing markets could face sudden supply shocks that could rapidly push prices downward. And unlike individual homeowners, institutional sellers move strategically and at scale. Millions of homeowners currently hold ultra-low mortgage rates from previous years. This has created what economists call the lock-in effect. Homeowners are reluctant to sell because moving would mean giving up low-interest loans for significantly higher rates. This reduces housing turnover dramatically. Fewer homes hit the market, inventory stays tight, prices remain elevated. But this system creates stagnation rather than genuine strength. If economic pressures, job losses, recessions, or personal financial strain force more homeowners to sell, the market could suddenly experience a release of pent-up inventory. That shift could happen faster than many anticipate. Not all markets are equal. Some cities that saw explosive pandemic-era growth are already cooling rapidly. Overbuilt rental sectors, migration slowdowns, and declining investor demand are exposing weaknesses in once booming areas. Commercial real estate troubles may also spill into residential markets as broader economic confidence weakens. The result? Localized corrections could trigger wider sentiment changes. And housing markets often depend as much on psychology as economics. If enough people begin believing prices will fall, buying slows further. That can accelerate downturns. The next housing crisis may not come from reckless lending alone. Instead, it could emerge from a combination of severe affordability erosion, investor concentration, demographic shifts, supply distortions, High interest rates, economic stagnation. This makes the potential crisis less obvious, but potentially more prolonged. Rather than a dramatic crash, we may see frozen transactions, persistent unaffordability, rising rental burdens, wealth inequality expansion, generational displacement from ownership. In short, a housing system that no longer functions for ordinary people. The real danger isn't just falling home prices. It's the possibility that housing, once considered the foundation of middle-class wealth, becomes permanently inaccessible for millions. That kind of crisis doesn't always make headlines immediately. It builds quietly, and by the time everyone notices, it may already be here. The housing market crisis nobody saw coming may not look like a collapse. It may look like a system that simply stops working, and that could change everything.